The Federal Reserve is at it again. Tomorrow, they're expected to announce a 25 basis point rate cut. But the real story? It's not just about this cut, it's about what's next. Experts like Noel Dixon, a senior macro strategist at State Street Global Markets, are already predicting a major shift for 2025, a more cautious Federal Reserve. Why? Because the stakes are higher than ever. Stick with me because in this video, we'll break down what this means for you, your investments, and your future. You're about to see how these moves can either make or break your path to financial freedom. Let's dive in. The Federal Reserve is navigating an economy that's anything but predictable. Inflation has cooled, but the aftershocks are still hitting. Consumers are feeling the squeeze, and businesses are watching every penny. Now, a 25 basis point rate cut might sound like a win, but here's the catch. It's a band-aid on a much bigger wound. As Noel Dixon points out, the Fed's aggressive rate-cutting days are numbered. Why? Because the economy is sending mixed signals, and surprises are lurking around every corner. Speaking of surprises, remember the last time your favorite Netflix show got canceled without warning? Yeah, the Fed's policy shifts feel a lot like that. Unexpected and frustrating. But why is the Fed pulling back, and what does it mean for your financial game plan? The Fed's cautious tone isn't just about playing it safe, it's about survival. Dixon explains that economic uncertainties are growing. Think global conflicts, fluctuating commodity prices, and yes, that pesky inflation that refuses to fully disappear. This means fewer rate cuts in 2025, possibly 1 to 2 fewer than projected. But don't let that sound like good news. Lower Fed could mean slower growth for your investments, higher borrowing costs, and, you guessed it, more volatility. And speaking of volatility, how will this impact lower-income households already struggling to stay afloat? The answer might shock you. Here's the reality. Not everyone is feeling the economic slowdown the same way. Dixon calls it a K-shaped recovery, where higher-income earners are thriving while lower-income households are barely keeping their heads above water. This bifurcated economy means spending habits are diverging. Luxury markets are booming, while essentials are becoming harder to afford for many. And when consumer behavior becomes this unpredictable, the Fed has to tread carefully. Quick question. Did you know that the price of eggs could predict your financial future? No? Well, it can't, but it feels that way these days, doesn't it? All jokes aside, the Fed's cautious stance has big implications for all of us, no matter where we are on this economic ladder. But here's the big question. How do we prepare? Let's cut to the chase. The Fed's caution is your call to action. This is the time to take control of your financial destiny. Start by diversifying your investments. Don't put all your eggs in one basket, pun intended. Explore opportunities in undervalued assets, boost your emergency fund, and if you're carrying debt, pay it down now before rates climb again. And for the love of compounding interest, start saving and investing consistently. The sooner you act, the more you'll insulate yourself from the uncertainty that lies ahead. Because here's the truth. In a volatile market, the winners aren't the ones who play it safe. They're the ones who play it smart. And there's one strategy that can set you apart from everyone else. Want to know what it is? The Federal Reserve's cautious moves in 2025 are a wake-up call, not a setback. The question is, will you seize this moment, or will you wait until it's too late? Remember, your financial future isn't determined by the Fed, it's determined by you. And if you're ready to take your financial knowledge to the next level, click here to watch my video on the power of compounding. This one strategy could change your life forever. Don't wait. Your future self will thank you.